Alright folks, welcome back to Boss Economics World, your weekly dose of financial reality. Hold the sugarcoating. Today, we're taking a trip to the beautiful, romantic, and economically schizophrenic nation of France. The date is September 10, 2025, and the Bank of France has just served up a headline that is, on the surface, as comforting as a warm croissant. The French economy is chugging along, projected to grow a steady 0.3% in the third quarter. Sounds lovely, doesn't it? A picture of Gallic resilience. The aerospace sector is soaring like a Dassault Rafale, services are advancing, even construction is doing better than expected. It's the kind of news that makes bureaucrats in Brussels breathe a sigh of relief and allows portfolio managers in London to keep their French government bonds filed under boring but stable. But you and I, we're not here for the bedtime stories. We're here to lift the manhole cover and see what's really happening in the sewers of the global economy. And let me tell you, what's happening in France is the perfect, terrifying microcosm of the great disconnect plaguing the entire Western world. This 0.3% growth figure, my friends, is not a sign of health. It's the steady, rhythmic beep of a heart monitor on a patient in the ICU, a patient whose doctors are in the hallway, throwing scalpels at each other while the hospital itself is on fire. Let's break this down, from the point to the surface, and see why this seemingly innocuous piece of data is actually a flashing red warning light for anyone with money in the game. First, let's talk about this growth. Whenever a central bank gives you a single, neat number like 0.3%, the first thing a sharp mind should ask is, whose growth is it? The Bank of France survey tells us the engines are aerospace and equipment sectors. Of course, they are. We're talking about giants like Airbus and Safran. These are global behemoths, propped up by long-term multi-billion euro contracts, significant state shareholdings, and a geopolitical reality that dictates nations must have fighter jets and satellites. This is not the real, everyday French economy. This is the gilded tip of a very rusty iceberg. Think of it as a K-shaped recovery on a national scale. You have a handful of capital-intensive, export-oriented champions soaring into the stratosphere, while the vast domestic economy, the small bistros, the local construction firms, the family-owned wineries, is bumping along the bottom. The 0.3% is just the mathematical average of a soaring eagle and a flock of dying pigeons. It tells you nothing about the health of the ecosystem. The report itself gives the game away. It mentions concerns are particularly high in the construction sector. Why? Because construction is the ultimate canary in the coal mine for domestic economic health. It runs on confidence. People build houses and companies build offices when they believe in the future. When the construction sector gets nervous, it's because they see rising interest rates, shaky consumer demand, and, most importantly, political chaos on the horizon. They know that a new government's first move might be to slash infrastructure spending or change housing subsidies, killing their entire business model overnight. So, this resilience is a statistical mirage. It's a headline built on the performance of a few state-coddled giants, masking the deep-seated anxiety gripping the real economy. It's like saying a family is financially healthy because the dad got a big bonus, while ignoring the fact that the house is in foreclosure and the kids can't afford college. Now, let's zoom out to the political madhouse that this resilient economy is supposedly ignoring. The news report casually mentions the unexpected confidence vote called by Prime Minister François Bayrou and the fact that his government fell. Let's put this in context. This isn't just a minor political squabble. This is the culmination of years of political fragmentation in France. We saw President Macron's shocking gamble in calling legislative elections in June 2024, which resulted in a hung parliament and empowered the political extremes of both Marine Le Pen's far right and Jean-Luc Mélenchon's far left. The government that just fell was a fragile, centrist coalition trying to walk a tightrope over a canyon of populism. And it failed. So what happens now? The report says that next administration will have to deliver significant savings to narrow the budget deficit. Here, my friends, is the heart of the matter. The real story isn't the 0.3% GDP growth, it's the 112% debt to GDP ratio and the budget deficit hovering around 5%. These numbers are not just academic, they are a death sentence for fiscal stability. Just last year, in May 2024, Standard & Poor's downgraded France's sovereign credit rating, citing exactly this, the deterioration of its budgetary position. The market has already fired its warning shot. The new government, whoever it may be, is trapped in an impossible doom loop. 1. The problem, they must cut spending and or raise taxes to appease bond markets and avoid another downgrade, which would send their borrowing costs spiraling out of control. 2. The solution, the left-wing coalition will demand higher taxes on businesses and the wealthy. The report itself notes lawmakers are pushing for more tax on business. What does this do? It stifles investment, encourages capital flight, and makes the real economy even weaker, further fueling social discontent. 3. The solution, right/center, they could try to implement austerity, cutting social programs, pensions, and public sector jobs. What does this do? It triggers the very strikes and protests that executives are already worried about, bringing the country to a standstill and killing any fragile growth. This is not a choice between a good option and a bad option. It's a choice between being shot and being poisoned. Every potential path leads to economic pain and social explosion. The Bank of France's uncertainty indicator, which saw a strong increase, isn't just a data point, it's the sound of thousands of business owners nationwide slamming the brakes on hiring and investment. It's the collective gasp of a market realizing that the adults are no longer in charge. Now, let's zoom out further. This French tragicomedy isn't a standalone performance. It's the headline act in a continent-wide festival of dysfunction I like to call Eurosclerosis 2.0. The original Eurosclerosis of the 70s and 80s was about rigid labor markets and overregulation. This new version is far more dangerous. It's a lethal cocktail of demographic decline, fiscal unsustainability, and political paralysis. Look around the neighborhood. Germany, the former powerhouse, is now routinely called the sick man of Europe again. Its industrial model, built on cheap Russian gas and limitless Chinese demand, has been shattered. Industrial production has been stagnant for years. The Scholz government is a bickering, unpopular three-way coalition that can barely agree on a lunch order, let alone a coherent long-term economic strategy. Italy, always the canary in the European coal mine. Its debt to GDP is a staggering 140%. Prime Minister Giorgia Meloni has managed to maintain a semblance of stability, but the fundamental math hasn't changed. The only thing that kept Italy from imploding over the last decade was the European Central Bank's ECB promise to buy its bonds and keep interest rates at zero. That era is over. The ECB's nightmare. This brings us to Christine Lagarde at the ECB. She is trapped. Inflation, while down from its 2022 peaks, remains stubbornly above the 2% target. But if she keeps interest rates high to fight it, the interest payments on French and Italian debt will become unbearable, potentially triggering a sovereign debt crisis that could unravel the entire Eurozone. The spread between French 10-year government bonds, 080s, and the benchmark German bonds has already widened significantly since the 2024 elections, a clear market signal of rising risk. If she cuts rates prematurely to save the debtors, inflation could reignite, and the euro's credibility would be shot. What we're seeing in France is the European model hitting a wall. The social contract of high taxes for generous welfare states only works in an environment of strong growth and stable demographics. Europe has neither. The political center, which for 70 years managed this compromise, is collapsing, squeezed by populist forces who offer simplistic, impossible solutions to complex problems. Finally, let's bring this all the way out to the 30,000-foot view, because this phenomenon of rosy headline data masking catastrophic underlying risk is the defining feature of our current global financial moment. Why do stock markets sometimes rally when the political and social fabric is fraying? Why does a 0.3% GDP print get reported as resilience? It's the great disconnect. Financial markets have become detached from the real economy for several reasons. 1. Indexation and passive flows. A huge portion of global capital is now in passive index funds. This money flows into the biggest companies, like the ones propping up France's aerospace sector, regardless of the underlying health of the national economy they're based in. It's a dumb money firehose that inflates the value of the giants, creating a distorted picture of economic health. 2. Central bank legacy. For 15 years, investors were trained with a simple mantra: don't fight the Fed or the ECB. Central banks always had their back. While that's changing, the psychological residue remains. There's a lingering belief that authorities will somehow step in and prevent a true catastrophe. 3. The narrative of AI and tech. The global market narrative is dominated by a handful of tech megacaps. Their performance can pull entire indices up, giving a false sense of a bull market even when a majority of stocks are struggling. This creates an incredibly dangerous environment for investors and ordinary citizens alike. We are being lulled into a false sense of security by backward-looking data points like quarterly GDP, while the forward-looking indicators, political instability, social unrest, and unsustainable debt trajectories, are flashing code red. So what does this mean for you, the professional in finance or the savvy individual who cares about their future? It means that political risk analysis is no longer a niche, exotic specialty. It is now macroeconomics 101. You cannot hope to understand the bond market without understanding the French parliamentary vote count. You cannot forecast the euro without understanding the social fault lines in Italy. It means you must learn to look under the hood of every headline number. When you see 0.3% growth, you need to immediately ask, where did it come from? Is it sustainable? And what is the standard deviation of that growth across different sectors of the economy? And most importantly, it means recognizing that the era of stable, predictable, fat middle returns is likely over. We are entering an age of volatility and fat tails, an environment where the seemingly unlikely, catastrophic events, a debt crisis, a major country leaving the EU, widespread social breakdown, have a much higher probability than the models suggest. Let's go back to our patient in the ICU. The French economy. The 0.3% growth is the steady, reassuring beep of the monitor. It tells you the patient is, technically, still alive. But the real doctors, the ones who aren't just looking at the screen, are checking the other charts. They see the fever chart of the Bank of France's uncertainty indicator spiking. They see the blood pressure chart of the bond spreads rising to dangerous levels. They see the patient's long-term prognosis, the debt-to-GDP ratio, showing terminal decline. And they hear the sounds of a violent argument among the medical staff just outside the door. This French report is not a story of resilience. It is a story of delusion. It is a perfect snapshot of a developed world that has become addicted to the illusion of stability, propped up by the performance of a few corporate champions and the fading memory of central bank omnipotence, all while the political and social foundations crumble beneath. So, when you see that 0.3% figure flash across your screen, don't feel reassured. Feel concerned. Because the most important sound in that ICU room isn't the beep. It's the growing silence between the beeps, and the terrifying possibility that the next sound you hear will be a flatline. What do you think? Is this resilience, or the calm before the storm? Drop your thoughts in the comments below. We need to talk about this. See you next time on Boss Economics World.